name is Laurel Williams, and today I'm going to be analyzing the financial statements of the following companies: Nissan, Whole Foods, and ExxonMobil. I'll answer the question, what company will I lend a 6-month loan of $1 million to? What company will I lend a 5-year loan of $1 million to? And what company will I buy 50% ownership of? So a little bit about each company. We have Nissan Motors, which Nissan manufactures and distributes automobiles and related parts. It also provides financing services. Nissan delivers a comprehensive range of products under various brands. The company manufactures in Japan, United States, Mexico, and United Kingdom, as well as other countries as well. Then we have Whole Foods, which Whole Foods Market owns and operates a chain of natural food supermarkets in the United States. The company's store provides a full range of merchandise featuring products that are free of artificial flavors, sweeteners, colors, preservatives, and added chemicals. Whole Foods also develops, produces, and markets nutraceutical and nutritional supplements. And then we have ExxonMobil, which is a corporation who operates petroleum and petrochemical businesses on a worldwide basis. The company's operations include exploration and production of oil and gas, electric power generation, coal, and minerals operations. ExxonMobil also manufactures and markets fuels, lubricants, and chemicals. So first we'll look at the short-term loan. For the short-term loan, I analyzed the financial statements of the following companies from 2013 to 2014. I chose Whole Foods Market, and I will explain why I chose to lend them the 6-month loan of $1 million, and I'll also explain what set this company apart from others. So the ratios I used to determine were the current ratio, quick ratio, and cash ratio. Current ratios are current assets over liabilities. Quick ratio, current assets minus inventory over liabilities, and my cash ratio is cash over current liabilities. As a financial analyst, you'll want all three of these ratios to be fairly high, but not too high. Usually a ratio of about 2.0 is the highest you'll want without there being problems within the company. So why did I choose Whole Foods Market? Because for average current ratio of about 1.61, an average quick ratio of a 0.93, and an average of a 0.77 for cash ratio, which they all stayed within the range that you would want for a company. Looking at the current ratio comparison, I have all three of my companies, Exxon, Nissan, and Whole Foods. As you can see, for the current ratio, Whole Foods was fairly high in 2013. They were the highest of the three companies. In 2014, they dropped a little bit, but it still showed stability between the two. For the quick ratio comparison, the same three companies, although Whole Foods was not the highest of either, they still showed stability, and also they ranged about a little below 1% ratio, which was really well for their company. And for the cash ratio, this was my determining factor on choosing Whole Foods because their cash ratio exceeded the other two companies by a ton. Whole Foods had a 0.77 average of the 2 years, which was really high, and that you can see here. So then we'll go to long term. For my long term question I had to answer, it was who would I choose to lend a 5-year loan to at $1 million, and that was also to Whole Foods. And I looked at the financial statement between 2010 and 2014. So I'll kind of talk about what sets this company apart from the others. The ratios that I used were the times interest earned ratio, which is earnings before interest and taxes over interest expense, and the total debt ratio, which is total liabilities over total assets, and equity multiplier, which is total assets over total equity. Looking at these companies in a long run solvency, you'll see you'll want the times interest earned ratio to be as high as possible, but your total debt ratio and your equity multiplier you want to be fairly low. So the average of all three of these were my determining factor. The times interest earned was a 767.86, which is extremely high for your times interest earned ratio, which was great. The total debt ratio was a 0.32, and the equity multiplier ratio was a 1.55. And like I said, these are the averages of 2010 to 2014 for each. So looking at just times interest earned ratio, this is just a Whole Foods, and as you can see here, in 2010 and 2011, they stayed fairly low in the ratio, but then they skyrocketed in 2012, and since then they did drop off a little bit, but they've remained pretty consistent over the last 2-3 years. Their times interest earned was, like I said, 767.86%, so that's extremely high, and it also, your times interest earned ratio is going to show how many, it's going to show like your periodical interest income for lenders, and whenever your company, if you have a weak ratio, then you'll want, your company will usually face difficulty, so that's why you want to stay high, which Whole Foods definitely did. So now looking at the total debt ratio, your total debt ratio is going to explain how many, the amount of assets you'll need to pay off your liabilities. A lower ratio is going to imply that you have a more stable business with the potential of longevity, because a company with a lower ratio has an overall lower debt. For Whole Foods, they had a very consistent low debt ratio throughout the past 5 years. Equity multiplier is the same. They stayed very consistent over the last 5 years, between 2010 and 2014. The equity multiplier shows the percentage of assets that are financed and or owed by the shareholders. Like I said, this ratio stayed very stable as well. And then we'll look at the equity, which I had to answer the question of what company would I buy 50% ownership of, and that I chose ExxonMobil. I looked at ExxonMobil between 2010 and 2014, and I'll explain what set this company apart. The ratio is used to determine where total asset turnover, profit margin, price to earnings ratio, return on equity, and return on assets. You'll want you want your total asset turnover ratio, your profit margin, your return on equity, and return on assets. You'll want it to be fairly high because it'll show that the business is strong and very efficient. But your price to earnings ratio is you also want it to be high, but if it's too high, it's gonna it'll indicate that the business is overpriced to actually buy into. So why these this is the averages of each ratio and kind of explains why I chose this company. The total asset turnover average was a 1.22, profit margin of a 9.27, price to earnings of a 12.50, return on equity 22.39, and a return on asset average of 11.35. So to look at these on a graph, we have the total asset turnover, which as you can see stays very stable between 2010 and 2014. Your total asset turnover ratio is going to show how efficient a company is in using its assets to generate its sales, which as you can see here, they had a fairly high ratio over all 5 years, and it also remained very high too. Next we'll look at profit margin by itself, which profit margin stayed right under a 10. The average profit margin for ExxonMobil was a 9.27. For profit margin, it's going to show the percent of sales that are left over after all expenses are paid by the business. So this ratio is really good for creditors to look at to see how effective a company is converting its sales into its net income. Then we have our price to earnings ratio, which here it shows in 2010 it was pretty high, but it fell in 2012, stayed pretty low in 2013. It did go up a little bit in 2014, but it didn't go up enough to where it was too high and the business was overpriced. I felt that Exxon was very well priced to buy 50% ownership of, and that's why I chose the company. And for return on equity, you'll see that it did a slow incline, and then it kind of decreased in 2012, which is fine because your return on equity is going to show how much profit for each dollar, how much your company will profit from each dollar of your common shareholders' equity. It also is going to help to determine how efficient a company will use their money to generate their net income. Investors always are going to want to see a high return on equity. And kind of the same concept for return on assets, they also stayed fairly high. It's well over the last 5 years, and the return on assets is just going to show how effective a company can manage its assets to produce profits during a period, or how effective a company can convert its money used to purchase their assets into their net income or profit as well. So a higher ratio is definitely more favorable for investors for both return on equity and return on assets. So that's just kind of an overview of why I chose the following the following companies: Nissan, Whole Foods, and ExxonMobil for my short-term, long-term, and my 50% ownership. Questions?